Welcome back to Personal Finance. This week we're definitely going to have two sections of the video, and there are additional videos and practice questions and reading on the Moodle site because we have a lot to cover. So we're going to talk about saving, financial planning, and investing, and we'll have additional questions at our next practice. Okay, first of all, the first section, saving, is a little bit of review, thankfully. The first thing you want to think about is when you're considering saving, you want to think of savings as future consumption, and it's a trade-off or it's a choice related to current consumption. So your income, your disposable income after tax, you can either consume or you can save. Remember, we talked about short-term savings and long-term savings. We will talk more later when we talk about investing, a little bit more about long-term savings. But for now, I just want you to consider that the opportunity cost of current consumption is future consumption, and the opportunity cost of future consumption is, of course, current consumption. So if you save lots of your money, you probably won't be able to buy the latest clothes or go to see movies. But if you spend all your money on current consumption, you go out and get burgers and go on trips all the time, that you might not be able to afford a house, you might not be able to go back to school when you want to, or send your kids to college. When you are looking at savings, obviously the interest rate makes a big difference, because the interest rate is the price for using money. And so if you are saving money, the interest rate is the price that the bank or whatever financial institution you're using, it's what they're paying you. If you are borrowing money, of course, interest rates have the opposite impact, right? So with savings, you want to have high interest rates so that you will have an incentive to put your money in the bank. There's two ways to look at interest. There's both simple interest and compound interest, and you're probably familiar with these concepts already from math class. Simple interest, if anyone asks you, if a question asks you to calculate simple interest is simply the principal times the interest rate times the number of years. So if you have $100 in your savings account and the interest rate is, say, 3%, right? After 1 year, you'll have $103. After 2 years, you'll have $106. After 3 years, you'll have $109. So you just keep adding the simple interest, but you don't get paid interest on the additional interest. So for example, with compound interest, you would have, let's say, $100 in principal and a 0.03 interest rate, and after 1 year you'd have $103, right? The next year, your principal would be $103, and you would earn interest on that. So compound interest, you get paid interest on the interest you've already accumulated. With simple interest, that would not happen. So this is the formula for compound interest. Your accumulation equals your principal times, in parentheses, 1 plus the rate of interest divided by the number of times compounded per year to the power of the number of times compounded per year times the number of years. So if you want to know how much money you'll have after a certain number of years, if your principal starting out was 100, right, your interest rate is 3%, and it's compounded, let's say, 12 times a year, right, then you would have 1 plus 0.03 divided by 12, and then you would take it to the power of, let's see, 12 times compounded per year. Let's say you do it for 10 years, so it would be 220. So the interest rate there looks pretty small, 0.03 divided by 12, right? But that's the actual interest you're earning each month, and then that tells you what your principal is at the end of each month, and then you take it to the power of 120. So you end up with a lot more money using compound interest. Normally, you're not really asked to calculate complicated compound interest on these tests because we don't have the use of calculators. The rule of 72 is a quick way to calculate how long it will take money to double under compound interest. So if the interest rate is 3%, we just take 72 and divide it by that interest rate, and we don't have to put it in decimal form. We just take the number 3, okay, and we find out that it would take 24 years for our money to double. So if you had $100 to start with and a 3% rate of interest, in 24 years you'd have $200. So that's a nice little shorthand to help you understand the value of compound interest. Inflation, of course, affects the value of your savings because it erodes the value of a dollar. So let's say a bank is paying an interest rate of 3%, but inflation's at 2%. The real interest rate you are earning is just 1%, which means the growth in your purchasing power is just 1%. So that $100 earning 3% interest, if inflation is 2%, you really, if you're comparing the value of your money a year from now to the value of what you have right now, you have $100 now, you have virtually $101 a year from now in real terms. The Fisher equation is a way to very, very simply come up with the real interest rate. You just take nominal minus inflation and get real. It is very simplified, but it works for small numbers. Okay, so if you have savings, you want to save money, where can you put it? You do want to know different types of financial institutions. So we have commercial banks, savings and loans, credit unions, and brokerage firms. Commercial banks are your traditional Wells Fargo, TCF, US Bank. Traditionally, they took deposits and they offered credit. So they would offer loans. They would also buy bonds. They would also have credit cards and other ways of offering money to people. Savings and loans were created primarily for the home mortgage industry. So the idea was that people would save their money in a community and then other people would borrow that money to buy homes. So very specific to the home mortgage industry, there aren't really a lot of savings and loans around right now. They really had a lot of trouble in the 80s when inflation was high, and so the real return on home mortgages was very low. A lot of them went bankrupt or got bailed out by the government. Credit unions are member-owned. So while commercial banks frequently have shareholders, like any other kind of company, they're like, Google, but their business is taking deposits and lending money instead of developing software. Credit unions are member-owned. So they are cooperatives, like maybe a food co-op, right? A lot of people might own a share in a food co-op, and then they would be able to, get some of the harvest, right? So with credit unions, the members own the credit union, so there's not the credit union itself is not a profit-earning business. So as a result, the members know that they're probably not going to earn a whole lot of interest on their deposits, but they also get lower interest rates on loans. So a lot of people belong to credit unions and use credit unions for things like car loans, and those are cheaper. Credit unions also will advocate on behalf of their members. So if you're a member of a credit union and you want to buy a car, they will often negotiate for you or help provide you with more information. Brokerage firms don't really exactly fit here, but I wanted to address them here. We'll come back to them more in the investment section. Traditionally, brokerage firms bought and sold stocks and bonds. They were not involved in banking. But with deregulation in the 1980s, it really blurred the lines between a lot of these different types of financial institutions. And commercial banks were able to take on some more of the roles of brokerage firms. And brokerage firms were allowed to take on, having accounts. So you can have like a Schwab checking account, right, which wouldn't have existed before that. So the explanation of the different types, the siloed sort of financial institutions, isn't necessarily completely true today, but I think for the purpose of the competition, it is probably still important to know the distinctions. Okay, within a financial institution, you might have these different types of accounts. So a checking account is primarily for liquidity, right? People put their money in a checking account rather than carrying lots of cash around, because if you're going to go pay, say, $800 for a really expensive purse at a store, you don't necessarily want to walk in the store with $800 in cash. Now, I realize a lot of people today would use a credit card for that purchase, but traditionally, people would put their money in a checking account, have that money immediately accessible, and be able to write a check to make a purchase. And we'll look at a check in just a minute. So the money in your checking account typically isn't going to earn interest, or it's going to earn a very low rate of interest. But there's no withdrawal penalty. You can take the money out anytime. You put the money in today, you can spend it later today. You might need to wait for the deposit to clear, but for the most part, that money is immediately spendable. A savings account is a little bit different. The expectation in a savings account is that you're going to put the money there and you're going to probably leave it there. It's not necessarily immediately spendable, although debit cards, which typically debit cards were initially tied to checking accounts. Right? Debit cards are a piece of plastic that looks like a credit card, but it's taking money directly out of your checking account like a check. Some people have debit cards tied to their savings accounts, and then you are able to actually spend the money immediately. But we're going to sort of associate debit cards or demand deposits with checking accounts. Savings accounts, the point is to put the money there and leave it. So savings accounts tend to pay a little bit more interest than checking accounts did. Right now, because of the low interest rates from the Fed and the low prime rate and, of course, the low federal funds rate, nobody's really paying much interest at all. But if interest rates went back up again, savings account interest rates would definitely be higher than checking account interest rates. And then certificates of deposit tend to have a little bit higher interest rates. They're still pretty low right now. These are also, by the way, referred to as CDs. But with a certificate of deposit, you promise, for example, I will leave this money here. I get a 10-year CD, and the bank gets to keep my money for 10 years. And then they might be willing to pay me a whopping like 2% for it instead of 0.02% for it. So the rates are really low, but during times when when rates are actually higher. If a checking account maybe is paying 0 and a savings account is paying, say, 3%, a CD might pay 5 or 6%. So they're definitely going to be more significant, but again, right now, there's really not a lot of interest being earned in any kind of traditional accounts. Certificates of deposit, like some of the other investment things we'll talk about later, are subject to withdrawal penalties, which means if you put your money in the CD and it's a 3-year CD and you decide after 2 years you need the cash, you don't actually get to keep all the interest. You will actually pay a penalty for taking that money out sooner. This is a picture of a check. I'm going to let you look at it and read the information. You can look at it on the PDF of the notes as well, but it's just to kind of let you know what these different numbers are because they do sometimes ask this. This little thing at the end here is just a transit character. Okay, this is your ABA check routing number, and it identifies your bank and your Federal Reserve, right, which Fed you're part of and your actual bank. This number is the one that's your account number. That's the one that uniquely identifies you. This is your check number, okay, and it should be the same number that's up here in this corner. And the last one is this automated clearinghouse number, which is very similar to the ABA number, and you can't really tell that here because everything's just 1, 2, 3, 4, 5. But this one is actually used for digital transactions like direct deposit. So if you have direct deposit or direct payment set up, so for example, you work somewhere and rather than getting a paper check, the money is actually going directly into your account and you just get sort of a copy of the check, that would be direct deposit. And the ACH routing number might be different from the ABA routing number. Okay, so you can read the rest of that, but you do want to be familiar with what the different numbers on a check are. All right, we're going to move on to financial planning for a little bit, and then we'll be done with this section of the video in just a few minutes. So the first part of the financial planning, we talked about this already. Assets are things of value you own. Liability is what you owe. Net worth is your assets minus your liabilities. And we talked about how net worth and assets and liabilities are all stock variables. Income and savings and expenditures are all flow variables. So the goal of financial planning is, I would say there's primarily 3 goals. One is to protect yourself against financial crises. So if you lose a job or you have a health issue, you wouldn't go bankrupt. Another goal is to save for long-term goals, like your education or your children's education, the purchase of a house, a nice car, possibly you might include vacations there. And then the third would be to plan for your retirement so that you don't have to work for your whole life. And I threw in there also inheritance, so that maybe you want to leave something to your children, to your spouse, or to someone else. So 3 things: avoid crisis, save for the big things you want, and be able to retire someday. Okay, so a few additional financial planning terms. These are ones that look to me like they would be interesting and important. There may be others that we come across and want to add to this. One is the debt-income ratio, which is what you owe monthly. So let's say that your monthly house payment, you owe, let's say, $2,000 each month on your mortgage, and you also owe $400 each month on your car, so you have $2,400 in monthly debt payments, and then maybe let's say you have another $800 in student loans. So you're paying $3,200 a month in your debt payments, and your gross monthly income is, let's say, $5,000, right? That's pre-tax, your gross monthly income, the actual amount that the business is actually setting aside for you. So you have there $2,800 divided by 5,000. So you've got about 56% debt to income ratio. That's not good. Credit companies and also mortgage lenders, and of course here I'm pretending you already have a mortgage, right? But they want you to keep it under 43% or you might not get the best interest rates when you're looking to borrow money. Life expectancy, the reason I noted this here is because life expectancy calculators are huge when it comes to thinking about planning for your retirement, right? The longer you're going to live, the more years you need to plan for. People really need to think about, possibly 20 to 30 years of retirement now, depending on those factors. And finally, one other term is assets, and we talked about this before, but one thing to think about with assets is whether they're going to appreciate or depreciate. And typically housing is going to appreciate, right? We certainly saw in the financial crisis that's not always the case. Vehicles, on the other hand, unless they're really collectible vehicles, like old-fashioned cars, right, they tend to depreciate as soon as you drive them off the lot. Other investments, typically people buy them because they expect them to appreciate. All right, we're going to stop this video here and we'll pick up on the next slide.